Good day, everyone, and welcome to the August episode of the University of Oklahoma Energy Institute's monthly webcast series. As part of the Price College of Business, the Energy Institute provides a community of practitioners and academics to advance innovative and sustainable solutions to the critical energy challenges facing the nation and, more broadly, the global community through education, research, and outreach. My name is Mike Stice, and I am the Dean of the Mewburn College of Earth and Energy at the University of Oklahoma and a member of the Energy Institute's Board of Advisors. I will serve as your moderator for today's discussion. You know, fluctuating commodity prices, increasing emphasis on climate change, and declining global energy demand due to the recent pandemic have collectively created a significant headwind for investments into the energy space. Today, we are joined by Steve Trauber, Vice Chairman and Global Head of Energy at Citi. Steve has a unique vantage point and significant experience within this space, and we have invited him to address some of the more challenging questions facing the energy industry. Conducting today's interview is Ashley Zumwalt-Forbes, President and Chief Operating Officer of Black Mountain. Ashley is an OU alumni and an extraordinary entrepreneur in the energy and mining industry with businesses both domestically and abroad. One could characterize Ashley as a modern-day wildcatter. We were thankful today for Ashley and Steve taking time to share their perspectives with us. With that introduction, let me turn the screen over to Ashley to begin our discussion with Steve.
Absolutely. So thank you so much for that introduction, Mike. As you said, I'm a Sooner alumni, so really happy to be here today with Steve. And Steve, I'll try to not be too hard on you.
Please, thank you.
Great. So, as Mike reviewed, the backdrop of decarbonization, a growing population, and COVID-19, it's really hard to remember a more challenging time for energy capital markets and specifically the oil and gas business. But as we all know, with challenge comes opportunity. And so, we're very lucky that there are few people better poised to talk about this opportunity and evolution than Steve Trauber. So Steve, I want to keep this really casual, very much conversational, but I do want to break it down into a few segments. So 1, future of energy capital sources, 2, energy transition, and then 3, career evolution and career transition. Does that sound good?
Sounds terrific, although you're setting that bar awfully high for me, but that's okay. Let's try to
Boom. Look, you got to start somewhere, man. No, you'll knock it out of the park. First, I want to address the elephant in the room. Is oil and gas the new coal?
Look, I don't believe so. And while some people in the sector, want to liken it to the coal industry or maybe even the tobacco industry, in both those cases, actually, coal had a new form of energy, or the energy sector had a new form of energy in the form of hot oil and gas that was cheaper, that was readily available, and at the end of the day, candidly cleaner than a lot of the coal that we produce. Tobacco, on the other hand, was one of those sectors that really wasn't needed, right? The energy sector and hydrocarbons is absolutely a worldwide need. It's needed in everything we do. From the moment you wake up to the moment you go to sleep, we're using energy. People want to forget that because so many of the things that are driven by energy are taken for granted. Likewise, we have a huge developing part of the world that is increasing their energy consumption and can't afford some of the other sources of energy. It's still oil and gas today is still the most abundant and cheapest form of energy out there. And at the end of the day, we're going to have to continue to drive that. I don't think it's going away anytime, certainly in our lifetime, and I don't think it's going away anytime in our kids' lifetime. Will it become a smaller percentage of the overall energy world? Sure. But renewables are growing. There's no denying that. And they'll continue to grow. Batteries, storage, there's all sorts of related things that come into play when we're talking that way. People forget how expensive renewables really is. And if you really go back through the whole life cycle of renewables, I'm not sure that we're really, at the end of the day, decarbonizing anything when you think through it all. But it is certainly going to be increasing form of energy. And so I think we need to, be prepared for that. And so I think the world is preparing for that. And I'm sure we'll get more into that as we talk.
I think you're exactly right, Steve. And what I really liked about what you said was, really emphasizing that both oil and natural gas can be that bridge to the future. It's not going to fully transition overnight. And so I think that's something that folks don't really appreciate, that you can't just snap your fingers and say, we're now 100% renewables, nor should we. So with that, let's chat about how on earth we're going to keep funding the fossil fuel business. So the U.S. university endowments and public pensions have been heavily pressured in recent years to stop investing in fossil fuels and divest from the industry entirely. What are the potential pros and cons of this divestment strategy?
Look, I think clearly whenever you constrict or restrict the capital flowing into any industry, there's going to be issues faced, right? I think first and foremost, one of the issues that the energy industry faces today was the easy and readily available abundance of capital that flowed into the industry. That drove some good things and it drove some bad things. It drove some bad habits, and it drove clearly the ability to fund a lot of entrepreneurs who were driving the cost of energy down and drove the abundance of energy up. I think when we now look at pension funds, endowments, et cetera, really kind of looking and analyzing whether they want to continue to invest in our sector and in the hydrocarbon industry, you really have to think about it from the perspective that if we restrict capital, several things are going to happen. Number one is you're going to have the effect of survival of the fittest. Right, those companies that are able to generate the best returns and best cash flow, free cash flow, are going to be the ones that attract the less available capital, which means there's going to be those companies that don't survive. Number one, maybe shouldn't survive, and it's going to force consolidation in the industry. So capital will continue to flow to those companies that can demonstrate that they can achieve the adequate rates of return that are necessary for investors. Second of all, however, if you lessen the availability of capital, you're probably going to drive out a lot of the technology that is required to be invested in order to continue to drive down the cost of energy. At a necessity, you're going to find those areas where the larger companies who have the technology will continue to deploy that, but they're not going to deploy new technology because at the end of the day, they can't afford to do it. They have to generate the returns. There's not enough available capital. They'll use their free cash flow generated within their companies to continue to grow their businesses. But those entrepreneurs, if you look at the oil and gas industry forever, it was really developed and created by entrepreneurs, all the way back to Rockefeller and onward. And it was available capital that helped drive the development of oil and gas around the world, and certainly in the U.S. onshore business, and certainly in the unconventional area, where the likes of George Mitchell and Aubrey McClendon and some of these, what I'd call the frac masters, if you will, the guys that started this early and really drove technology. They were able to do so because capital was available. Again, if you constrict the capital, we're not going to have that technology. We're not going to drive down the capital. We're not going to have as much availability of that capital because it's going to become more expensive. And therefore, that has global implications from a geopolitical perspective as well. Trade balances, our position. One of the reasons we are as strong as a country today is because we have solved our energy dependence. We are no longer dependent on any other nation except the U.S. for our energy consumption. In fact, we've started to export energy. And a lot of that has to do with the availability of capital that's been out there for a long time. I would argue that if you start to constrict that has real geopolitical ramifications. It's certainly going to, as I mentioned, lessen the availability of oil, and therefore, on the margin, drive oil prices up. And so I think there's got to be a balance. Forever, this industry was a growth industry, and it was all about growth. How fast could you grow production? How fast could you grow cash flow? And those guys that were growing faster attracted the capital. And then 2014-15 hit, we had a major slowdown. And all of a sudden, all the companies that were attracting capital were expected to be generating free cash flow and returning that back to shareholders, but none of that cash flow ever showed up. And investors started wondering, are we destroying capital. And in fact, I would make the argument that in many cases with many companies, we've been destroying capital for a long way because it was all about growth. Companies and management teams were incentivized to grow their business because that's how they got rewarded. That's how they got the higher valuations. That's how they were able to ultimately flip their businesses. If you're a private equity, you flipped it to the public markets because you grew in size, or you flipped it to a larger company and you achieved wealth at the end of the day. Investors have woken up to the fact that we need to achieve adequate rates of return. That means returns in excess of your cost of capital, which I would argue most companies in this sector have not done for a long, long time. And so now all of a sudden capital will be restricted. It will, like I said, flow to those companies that can achieve those returns and achieve adequate rates and also free cash flow. That's probably good. Discipline of capital is probably good for this sector. We need those companies who are the best, most efficient producers to be the ones that survive. And so I think there's some good that will come out of it, and there'll be some bad from a technology development and the availability of capital that's allowed so much development in science to take place in the sector for the last 10, 12 years.
I think that's a fantastic summary. And you are right. The industry could do with a good dose of common sense and returning to true profitability for investors, because it's very easy to condemn something when it's not making money either. So I think very wise advice there.
Well, I would just say, as you said, that you're absolutely right. I should have covered that. It's easy to put down the oil and gas industry when we're going through the changes. COVID was one of the, as everybody knows, one of the most traumatic experiences for oil and gas industry. When you shut down demand, you shut down all transportation. Nobody's driving to the offices. You shut down flight travel. You shut down manufacturing facilities, et cetera. It's going to have a dramatic negative impact on the demand of oil and gas. This is a supply and demand. You got to have a balanced supply and demand, and you can't shut down supply as quickly as you can shut down demand, as we saw. And so, it's easy to condemn. It's easy to say that in the last 4 or 5 years, oil and gas industries have not been able to generate cash flow and not been able to generate. So it's bad. It's a bad industry. Well, the reality, it's really not. It's, like I said earlier, it's what allows us to have many of the luxuries that we all have in life. And it's striving of the developing nations to want to have some of those same sort of luxuries and increase their standard of living. And what's going to continue to drive demand for hydrocarbons.
Absolutely. Never bet against human ingenuity. $30 billion have been raised so far in SPACs in 2020. Do you think this will continue being an attractive instrument? And what role do you see SPACs playing in the energy industry?
Citi has been at the forefront of energy SPACs, and candidly, we're at the forefront of all SPACs. We're very fortunate in that regard because it is a growing trend. I can say the energy industry as a whole, as it pertains to SPACs, has been somewhat mixed. But it's really only been mixed because the energy industry as a whole for the last 4 to 5 years, when SPACs were growing rapidly, has been challenged. So the SPACs is really just another form of being able to go public. And in an industry that really doesn't need or want to see a lot more public energy companies, because we have so many that have been created over the last 10 to 12 years with the growth of unconventional and the associated services that go around that. It's been much more challenging to convince energy investors to invest in new companies that are being formed and going public. And so while I think we will absolutely see some more SPACs, because candidly there's capital that needs to be derived, and there's always opportunities for entrepreneurs and for management teams that can find opportunities, can acquire those opportunities and can put them into the public markets and grow them. But it's going to be unique. It's going to have to be, situations that are not just another E&P company, not just another mid-cap E&P company, because we got a couple hundred of those. It's going to be something unique. It's going to have to be a unique story with a stellar management team. And you've seen those that have done real well in the SPACs, or ones that have had very strong management teams that the market wants to back anyway, because they've already provided substantial returns for investors in the past. And those are the sorts of things that will happen. We're on the road right now with a new energy SPAC. We're raising money as we speak for a new energy SPAC. We kicked it off yesterday. So there will be those opportunities, because there's still a lot of private opportunities that are owned by private equity, whether it be in the upstream or even midstream or oil field services, that are looking for a home. They're looking for ways to be able to attract new capital. And so there will be select opportunities in the energy sector. I think where it's really, SPACs really come into play is in other growth-oriented industries. Because what's unique about going public via the IPO route versus going public via the SPAC route is that the management team gets to come up with their own forecast, and you get to use your forecast, not forecasts that were created by analysts in the context of an IPO. And so for those growth industries that may not even have EBITDA today, or may not even have revenues today, in the case of Fisker, for example, with the Apollo SPAC, energy SPAC, took 2 years, couldn't find an adequate opportunity that would be compelling for energy investors to invest in, ended up in the process right now looking at a Fisker electric vehicle manufacturer to take public. And now we're looking at projections that are coming out for management team in order to sell those, as opposed to some analysts that are going to come up with ones that you may or may not agree with. So there's clearly the opportunities in SPACs in the energy sector. I think it will be selectively available in the energy sector, probably a lot more outside the energy sector, until the point in which the energy sector proves to itself and proves to investors that it is an investable sector again, that there is growth opportunities and return opportunities in this sector. At that point, there will probably be several more energy SPACs that come out.
I think that's really encouraging news for resource entrepreneurs. So flip side of the SPAC funding question, what do you think the future is of energy private equity?
Look, I think energy private equity will continue to exist. It will be a lot smaller industry with less capital. As we know, there are a tremendous number of portfolio companies held by energy private equity today that are struggling to figure out how to be monetized. There's not a lot of companies out there with a lot of cash available to buy them. There are some transactions that are being discussed and will continue to be discussed as far as, public companies buying it with their stock as a way to get liquid, and ultimately private equity disposing of those shares that they receive in those transactions. As I mentioned earlier, the market is really not looking for a lot of new IPOs. So private equity for a long time, they'd make acquisitions, they'd fund management teams, they'd grow these companies, they'd develop quickly, and then they'd either flip it to another bigger company or they'd take it public. Well, if the public market's really not available anymore, certainly not near term, and it hasn't been for candidly a couple of years, then you got to look at who's out there to be able to buy these companies. And in a lot of cases, companies are focused inwardly. They're slowing down their growth. They're staying within their cash flow. They're not growing as rapidly as they were because, as I mentioned earlier, they weren't generating the sorts of returns that the market needs to see. So they're slowing down. And by definition, when you're slowing down your drilling and slowing down your development, you're extending the life of your existing assets. These companies no longer need to go pay and go chase for opportunities. So the buying universe has shrunk dramatically. Doesn't mean there won't be ongoing opportunities for those portfolio companies to get sold, but it's going to be a lot slower. And the returns in the public markets and in the private equity markets have been rather horrible, to be honest with you, in the last 5 or 6 years. And so, a lot of the private equity firms that fund energy, whether it's a dedicated energy buyout firm or whether it's a segment of a bigger multi-sector firm, they haven't performed that well. And limiteds who are invested in these things haven't gotten their capital back quick enough. And so they're having a hard time raising new funds. And so therefore, I think a number of these private equity firms are doing a few things. Number one is they're diversifying. They're going into infrastructure. They're going into renewable energy under the same flag as energy fund. So I think you'll see less private equity going into the historical hydrocarbon business until such time that those businesses start to be able to generate real returns. The minute that these sectors and these companies start to generate significant returns, I promise you capital will flow back. It'll flow back by private equity. It'll flow back by the capital markets. But there will be a shrinkage. There needs to be a shrinkage. Some of the sins that we're living through today is because so much capital, so much cheap capital came rushing into the energy sector. And it came from private equity, it came from capital markets, it came from the banks. And now I think a little constriction, a little restriction on that capital will create real discipline in the industry, which will allow the industry to start to hopefully generate better returns and will make it an investable sector again.
Yep, I think that's also very sage advice. Do you see availability of capital in the public versus private sector changing at different paces or on different timelines?
Private equity tends to be longer capital. You have to go raise the funds. You got to get LPs to make the decision to invest in it. Then you got to find opportunities. Then you invest in it. And then, these funds are typically, 7 to 10 year type funds. And so they hold it a lot longer. Capital markets have a much shorter term memory. They move capital a lot quicker. It flows much quicker. So I do absolutely see that the capital markets, the public capital markets, do move faster when the energy sector starts to show that they can generate the sorts of returns and cash flow that are necessary to invest capital. The capital markets will be the first ones back in. Private equity will follow, but much more slowly. And so I do think there's a definite velocity difference between capital markets, public capital markets, and the private equity market.
I think that's probably right around just the general, once the industry actually starts getting some momentum back and really generating that common sense profitability, folks start getting dollar signs in their eyes, as we all do. So I think that's exactly right. I want to make a transition away from talking through capital availability and capital sources and go towards the kind of future renewable energy space and how you're viewing the energy transition to date. So BP announced plans to pivot away from oil and gas and invest significantly more in low carbon energy. So they have a goal of increasing annual investment to $5 billion by 2030. So, 10 years from now. Do you think this transition to greener energy will be powered by oil and gas majors? Or do you think it will be powered by other folks?
Yes and yes. I think truly it'll be powered by both. Certainly, the likes of BP, Shell's made not dissimilar announcements as they're going to transition more to power and other energy sources. These are very large companies that generate a significant amount of capital, attract capital, and will continue to be able to, because of their size and scale, technology understanding, footprint around the world, et cetera, will certainly help drive renewable energy. There's no doubt about it. But at the end of the day, also, never underestimate that entrepreneur with great ideas, right? A lot of renewable energy, most of renewable energy, has been driven by entrepreneurs with great ideas, Elon Musk, et cetera. These sorts of people will continue to drive. There's capital flowing into new technology. There's capital flowing into greener energy, if you will. And so I think it's going to be a combination of both. If you look at the energy industry, like BP and Shell, if you look at where a lot of the technology for what they do in the hydrocarbon business came from, it came from entrepreneurs. It came from the oil field service sector. It came from people who had access to capital, but were able to develop technologies to help drive down the cost of hydrocarbon energy. Same sort of thing is going to happen in the renewable space. Certainly, there will be opportunities. And they will make acquisitions and they'll start greenfield opportunities in various forms of renewable energy. But the new technologies we don't even know about today, will continue to be developed by entrepreneurs, by funded by venture capital and angel capital, et cetera. So it's that human ingenuity that creates lots of industry, and it's going to continue to develop on the renewable side. It'll hopefully over time drive down the cost of renewables, because renewables still today is significantly more expensive than hydrocarbon. But I think over time that'll come down as well. And it's going to compete for capital dollars. It's going to compete for end use. And I think that's a good thing for both the renewable business and for the hydrocarbon business.
Yeah. And I think the energy industry, something that we've done really well historically, is be innovative and just continue pushing that ball down the field. And so, if you look at this landscape on the horizon, you can see that, that same spirit and entrepreneurial capability that made oil and gas so successful here in the US and globally will continue to exist in the renewable space. And it's something that I myself am seeing over on the mining side of the business. We started a battery metals mining company, specifically nickel for lithium ion batteries. And it's amazing how many oil and gas technologies or concepts are now being applied within the mining space as brand new technologies and really revolutionizing things. So it's something I'm personally very excited about to see on the renewable side and see how we can come together, not be each other's enemy, but very much work towards this better, brighter future for everyone.
It's interesting because you are absolutely right. And for people that are new to the energy sector, students and people who are not in the energy sector, most of them don't understand the amount of technology that it takes to develop the hydrocarbons, right? And the amount of technology that's continuing to evolve around the fringes and moving into renewables. And if you think about all of these large oil companies, and even the smaller, they're filled with engineers. They're filled with folks who have been trained to think creatively and solve problems. And these are the folks that are going to take us to the next level. And so I absolutely agree with you. A tremendous amount of technology and know-how within these big oil companies that will expand. And I think many of the oil and gas companies today will be companies that have hydrocarbons on one side, renewable on the other. And it's the global integrated energy chain at the end of the day, delivering energy of all sources to the end user.
Do you think the remaining major oil companies that have yet to make these energy transition announcements will follow?
I am 100% convinced that all of the large companies will absolutely do so. There's going to be a tremendous amount of pressure for them to do so. This wave started overseas, right? And there's tremendous investor pressure, consumer pressure on those energy companies to change and evolve. And those pressures have been less in the U.S., to the likes of Exxon and Chevron, for example, but they're coming. Large investors are increasingly putting that pressure on. So they too will evolve. Doesn't mean they're going to get out of their hydrocarbon business. I think they're going to be integrated. I think they're going to be a provider of all sources of energy over time. And so they too will evolve. What does do is take a lot of capital. So I think that there will be a limit as to, some of these independents, the medium-sized independents aren't going to have the capital base. They don't have the capital base kind of like today to drive their hydrocarbon business. And so they're not going to have the ability to kind of move and pivot toward other forms of energy. Although when I say that, I also recognize there was a company based in Europe called Dong Energy, and they now called Ørsted Energy. It used to be a complete hydrocarbon business. Today it's 100% renewable business, right? So you do have those companies that have the ability to pivot, have the ability to attract capital and remake their business. And I think we'll see some of those amongst the independents. There are some of the big players today like Oxy that are doing a lot in terms of developing cleaner energy and decarbonization. And so that's a big, well-capitalized company today. But there are other companies I think that are even smaller than that will do something similar to what Ørsted has done.
You know what I think is a really interesting dynamic among these large oil companies and with Oxy, as you mentioned, is they're developing these kind of venture capital arms for the renewable energy, more green energy, or just new technology. So to your point, these innovations are going to continue coming from entrepreneurs and smart people. We want smart people thinking about this. But do you view, these venture capital arms within major oil companies as playing a large role in renewables in the future?
Absolutely, increasingly so. Historically, many of these companies have had venture arms, but they've looked for technologies and helping to drive down the cost and of hydrocarbons. But today, it's pivoting to looking at the renewable, the cleaner energy. It's done for multiple reasons: sustainability of their businesses. The future is highly uncertain, and where we go with the renewables versus hydrocarbons is still yet to be really explored and developed long term. And so these companies, for sake of sustainability and a defensive measure, they want to make sure they're keeping their oar in the water as it pertains to all sorts of energy. Number two is they really want to attract the new millennials, the next generation. A lot of folks coming out of school, they lived and they thought about hydrocarbon and they know about energy, but they want to be on the cutting edge. They want to be thinking about renewables. And so to be able to attract a lot of those folks into the organization, knowing that the organization is going to help develop some of the new technologies of the future, but also you may have an opportunity to work in that area on a go forward basis. And as that business continues to grow, and if they're successful and draws more capital, that business will likely grow. You're going to have more opportunities there. So I think it's a very smart decision by these big companies to have these venture funds. They need to. They're big. They draw a lot of capital, and they ought to be at the forefront, as I mentioned, in helping develop and evolve that technology.
I think it's all about that blended approach going forward.
I couldn't agree more.
Good old common sense. But according to stock market data, investments in green energy have delivered better returns over the last 5 years than those in fossil fuels for a lot of the reasons that we've talked about today. but global investment in green energy remains relatively low as a percentage of hydrocarbon investment. Why do you think that is?
Well, first of all, if you look at the returns, to a certain extent, it's a law of small numbers. It's easy to grow 100%, 200%, 1,000% over a couple of years when you start really, really small. So returns have been there. Number two is it's really the attraction of capital, right? People want to invest in areas that may be evolving, where there may be unique growth opportunities and better returns in the future, with things that are growing. And so capital has flowed there, but the investment, as you said, has been a small fraction of the hydrocarbon, because the hydrocarbon, people don't understand this. The hydrocarbon is a global business and attracts hundreds of billions of dollars a year in developing all of the energy that we need to live our lives, right? So that's going to continue to be a massive investment for all capital providers. It has to be. Otherwise, we're going to go to a standard of living we're not going to like. And so we need to continue to develop that, but at the same time, continue to invest in the technologies. The other side of this is that a lot of the renewables haven't been very profitable, right? I mean, a lot of renewables that are today, fortunately, have been subsidized by the government. It helps these industries get off the ground. If you left up just to the entrepreneurs, it might have been a whole lot slower with a whole lot less capital, because the returns generated in those sectors, until you get to economies of scale, until you develop technology, it's kind of like the phone. Right, the phone, we used to have these big phones and they're expensive today. They're real small, they're less expensive. You got carriers that are offering all sorts of, free texting, free everything, because we've been able to drive down the cost. We are doing that in renewables as well. But we needed some help from the government originally. As they develop economies of scale, as they continue to evolve their technologies, costs are going to come down. More and more capital will come into it. The other side of it is there's been a lot of capital, whether it be from Silicon Valley or other places, that have been pouring money into this. It's a good thing to have a greener environment. It's a good thing to think about decarbonization. So money has flowed into it, much like it flows into a lot of technology startups that may or may not ever make money in the future. But it has come into the sector, and will continue to evolve technology to a point where hopefully over time there'll be many sources of renewable. We got biofuels, we got waste oil to oil. We've got all sorts of ways of being able to generate energy today. And some of it's profitable, some of it's not. But over time, hopefully, we'll identify more opportunities, and those that we currently are aware of, the cost will come down and more money will flow. So I'm not too worried about it. I mean, I think increasingly capital will continue to flow. As you mentioned, the large, well-capitalized major oil companies, the BPs and the Shells, et cetera, Equinors, Totals of the world, are putting a lot of capital into this sector. That's going to drive more investment into that area, and it tends to perpetuate itself. I think there's an velocity acceleration that will pick up as these technologies continue to thrive, as people make money, and a lot of capital is coming into it. So I think that'll continue to drive it very quickly.
Something you touched on was government regulations and subsidies. To what degree do you think regulations and subsidies will play a role in our greener future?
Look, I think in certain areas they'll play. I think governments are phasing that out, right? As we can imagine, as a result of COVID, we talked about COVID earlier. Governments don't have a lot of excess capital, right? I mean, we're going to have a huge cost to pay because of all the subsidies that the government has provided to keep economies around the world going. They're not going to have a lot of extra capital to be deploying into some of these technologies. The good news is that a lot of these renewable sources, the renewable technologies, have started to be able to be profitable on their own. And this is spinning off other forms of technology, other forms of renewable energy. And so I think increasingly, many of these companies will be able to stand on their own, and they won't need government subsidies. And I think, we peeled back a lot of the government subsidies. Those that are still exist will probably continue to get peeled back as this sector blossoms, right? This sector was in its infancy, and it's starting to really grow, and it's going to start to generate its own returns. And those that can't generate returns, maybe aren't right long term. But new technologies will come and replace those that aren't able to generate returns. And this is going to be the next decades and decades of evolvement in technology, like we continue to see in the technology sector itself.
Something that really strikes me is that over the course of history, efficiencies have always won out. And something that was a really compelling fact for me on convincing myself that EVs are coming, we are transitioning, is that Electric vehicles are more efficient than internal combustion engines due to heat loss. And so as you look towards this future, and as you said, we continue throwing smart people at the energy business and driving down those costs. I do truly believe that we are in the midst of a transition. But I think you're right. The pace of adoption is inevitably going to take time to get down to cost parity. But I personally am convinced like that's certainly where we're headed.
Now, look, I do too. But then when you look at the IEA and you look at the sale of SUVs, it dwarfs the sale of electric vehicles. Many more SUVs. I think 1 out of every 2 now cars being sold, certainly in the U.S., are SUV, consuming more energy. But I agree with you. But there's still technology, battery storage. There's still a lot of technology that needs to be developed in order to really make that viable for a lot of people. And second of all, it's hard to change consumer likes. We've been driving gas-powered, gas-fueled cars for a long time. People like their cars. They like the variety of types of cars you can get. So yes, absolutely, electric vehicles will continue to grow. And I have to say that everybody that I know that owns a Tesla loves it. So this is not meant to be an advertising for Tesla, but I've got energy executives, interestingly enough, that drive a Tesla and they love it. And so as the consumer evolves, it's going to take a long time. Consumer choice and taste take time to change. I agree with you. It is important to note, though, when you look at the full development of an electric vehicle, from the sourcing of materials to everything, at the end of the day, when you look at the full carbonization that is created as a result of that, I'm not really sure you're saving a lot of carbon, right? And yes, in the actual driving of the car, absolutely. But full development, I'm not 100% sure that is. So but that'll evolve too. All these manufacturing plants are working towards zero emissions, and so that too will evolve.
Yep. So 2 points over here. One, as a data point, Oklahoma girl drives a Tesla. So
don't say that too loud in the energy sector.
I do love it. I do love it. But second data point is around what you said about supply chains. I also think one of the core ways the world is going to change post-COVID, and this reflects on the energy business strongly, is being very focused on the supply chain, where things are coming from and how they're sourced. So I think you're exactly right. So often consumers, and myself being guilty of this as well, you buy something because it makes you feel good about what you're doing, right?
Exactly.
I am driving an electric vehicle, I'm doing my part. But if you look at the supply chain and you think critically about where things are coming from, I think you can make more informed decisions. So data really is power.
It really is. I agree with you completely.
All right. So we're transitioning to the last segment here, Steve. And this one is about career evolution, and really just see how you would advise either students or young folks entering the industry. Importantly, I turned 30 last week, so I'm no longer a young professional, but what would be your message to students looking to go into oil and gas, or folks early in their career in an oil and gas company?
Look, first and foremost, I'd say, as I said earlier, oil and gas industry is not going away in my lifetime. It's not going away in our kids' lifetime. It is going to continue to be a very vibrant sector. It will evolve, as we highlighted with BP and Shell. It will go from being a fully diversified energy source. So you may come into an energy company in a hydrocarbon-based business today that evolves over time, that could be Ørsted, could be all renewables in the future. I think those are probably less likely, but certainly could be part hydrocarbon, part renewables, and you're going to have the opportunity. So I would not ignore the oil and gas industry. Secondly, to those that are, I haven't looked at the numbers, but my guess is there's fewer and fewer people going into the petroleum engineering space because of all the things we're talking about. Whenever there's a shortage of people, there's a demand and there's a wage and wealth effect there, right? So there's always going to be that opportunities. And the skills you develop, let's not forget, there's a lot of skills you develop by being in the hydrocarbon. There's great technologies. as we talked about, there's geopolitical factors you have to deal with, you have to learn about, right? There's attraction of capital. You have to know about capital sources to be able to fund. There's all the analytical work that goes into this. Engineers and even those that aren't engineers that are going into the hydrocarbon business, either in the finance side of it, corporate development side, they're learning a lot about developing a big skill base that can be used in a lot of different places. So, regardless of how this sector evolves over time, those people that learn those skills are going to be very useful going forward. And I would argue there's going to be, with a fewer supply of engineers, there's going to be a higher demand for them. And that means they're going to get paid more going forward. So don't give up on those degrees. The sector needs you. It depends on you. And I would strongly encourage those that have a zest for the energy industry, not to just think about it being a hydrocarbon industry, but really being a broad-based energy sector that will incorporate all of the renewables. And as I mentioned earlier, technologies that we don't even know about today. And that'll all develop, and we'll be an energy sector known for, we won't be known as a hydrocarbon sector. We're going to be known as the energy sector. And I think there's going to be opportunities for everybody.
I was once given a piece of advice that it really resonates with exactly what you just said, Steve. But when I was leaving business school, one of my mentors told me to look at where everyone else is going and head in the opposite direction, because you really want to differentiate yourself. And I love that in kind of the vantage point of studying petroleum engineering or looking at the oil and gas business. I myself am a Mewburn College alumni. I'm a petroleum engineer. And I now run a global battery metals mining company. Did I study mining? No, but it really does go back to those fundamentals and really just a way of thinking. So couldn't agree.
Absolutely. Fully agree with you. And congratulations.
Thanks. So how do you think professionals can keep their skills sharp to stay competitive in this world?
Look, it's like any industry, right? I think it's a matter of continuous learning, right? You're always building the foundation. When you're coming out of school sets some foundation. When you're coming out, you think about where can I get the maximum exposure going forward and develop that universe of skills. And, I tell people coming out of industry, I love obviously recruiting into investment banking, because investment banking, it's not just about financial analysis and quantitative analysis and strategic thinking. You're dealing with all sorts of companies, and the projects you work on are changing all the time. So you're learning constantly. And you're also working with senior executives who probably at the time you're working with them, they're dealing with the most important strategic or financial issue associated with that company. And you're in the midst of that discussion. And so you are learning all the time. So it's kind of building those blocks. It's also, what I'd say, continuous education. You got to read, you've got to network. There's conferences all the time where you can go and hear experts talk about various topics. There's podcasts you can listen to. So, it's the inquisitive mind. Those that want to continue to learn and sharpen their skills will find those ways, right? In today's world of technology and social media, there's all sorts of, there's countless ways to develop your skills. It's not just the traditional way of going into work at 8 a.m. and going home at 5 or 6 at night, which, by the way, we don't do in the investment banking world. That's a half a day for us. But in all seriousness, it's those inquisitive minds that really want to learn, that really want to challenge themselves and want to go the extra mile. If you're complacent, just kind of going to work, you're going to fall behind, because there are a lot of people out there that want to develop and, as you mentioned, sharpen their skills, broaden out their skill base to make themselves much more marketable and be able to move into the direction that, they want to ultimately be able to move. So I think there's no shortage of opportunities for people to do this.
Yep, that's exactly right. And I think particularly because so much is uncertain right now and unknown about how the world's going to evolve over even just the next year, as we continue grappling with COVID-19, that you owe it to yourself to keep those skills sharp, like get out there and keep learning and keep figuring out how you can improve yourself or your company. Because we're really all dependent on each other right now, more than any other time.
No doubt. And then look, the other thing I would say is find yourself a mentor. Find somebody who's been in the industry for a long time. Talk to them. It's amazing to me how many people don't reach out to people who've been in the industry because they're intimidated by those people. Well, you got to remember, those people were in your shoes 20 years ago. I was on the phone yesterday with somebody that was really thanking me for spending the time with them. I said, I was in your shoes when you were coming out of college. I was there. I want to be able to give back. I want to be able to help educate that next universe of people that are coming behind me. And so many people are in that camp. So again, it goes to, having the desire to want to reach out and go that extra mile, because those people are out there, and they want to teach, they want to mentor. And I think it's incumbent upon young people, young professionals, to really reach out and take that opportunity.
Definitely. So Steve, I'm just going to start blowing you up every day. I've got this thing I need to talk to you about.
Yeah, all the students who are going to be watching this is something. Yeah. Anybody else who watches, my number is going to be on the billboard somewhere calling. Look, cool. we need great, creative, smart people in the sector. We need to continue to attract them to the sector. I can tell you, the young folks that work with us are very busy all the time. They're learning, they're creative. Are they going to be in this industry 5-10 years from now? I don't know. But will they have developed a skill base that'll be second to none? 100% certain of that. So, there's still great opportunities for, whether it be in the oil and gas industry itself, whether it be in the financial industry or associated industries in between, service industries. There's great opportunities for young professionals out there today.
Very encouraging. So Steve, I think because Mike has unmuted himself, we might be out of time, but thank you so much for the conversation. It was incredibly enlightening. And I feel like I learned a lot. So I really appreciate it.
Well, Ashley, thank you. It's been my pleasure.
Ashley, you did a fantastic job. And Steve, you didn't disappoint, as I knew you wouldn't. I wanted to offer you, Steve, any open remarks that you might want to make. I know we covered a lot, but was there anything that we just touched on that you want to elaborate on? I want to give you that opportunity.
Probably not. I probably summed it up there at the end. For the folks that will probably be watching this, I really want them to keep an open mind. I want them to know that there's great opportunities in this sector. It's a sector filled with extraordinarily smart, creative, entrepreneurial people. Yes, is the sector going to evolve? Absolutely, as it should, as every sector should ultimately. And are you going to be in the midst of so many fascinating aspects of life at the end of the day? I mean, energy provides what we all have, and you're going to be in the midst of that industry if you so choose. And like I said, there's geopolitical factors to be aware of. What's going on in Russia? What's going on in OPEC? When does Libya, Iran, and Venezuela oil come into the marketplace? What impact does that have on not only trade balance, but also commodity prices? What does that mean for the energy companies themselves? What's the impact of renewables? There's so much to be known and so much to develop, and it changes, day to day. It's not one of these slow industries that change year to year. It changes day to day, and you got to be on top of that. And for those in the industry, it's extraordinarily exciting. So again, I would encourage folks to keep an open mind. It's a great industry, and we look forward to having hopefully a lot of OU folks in the energy industry going forward.
Well, that's wonderful, Steve. Thank you. I'll just do a quick recap. You said so much that I thought was powerful and relevant for the audience. The conversation around oil and gas is not the new coal. You made the very valid point that oil and gas is needed and frankly, it continues to be abundant and least expensive. And there's this increasing demand that's going to have to be met. And so, as you said, this industry is not going away. It's going to be here for your lifetime and frankly, our children's lifetime. You transition to the abundance of a capital. I love what you said about how capital can offer good things and bad things. And on the good things side, we saw a lot of new technology development. We saw the advent of the unconventional space, and it was done because of this abundant availability of capital. But unfortunately, that drives bad behaviors too. We had some bad habits. We had an oversupply as a result. And there's a lot of inefficiency and frankly, capital destruction that took place simply because capital was almost too available. And when you talked about the transition to a more restricted capital environment, the one that we are finding ourselves in now, that financial discipline is actually a healthy transition. It's something that we need to go through. And you are going to see consolidation and rationalization of the industry as a result. But technology development, unfortunately, will probably be slowed because capital is not available. You made that point. You highlighted the different vehicles like SPAC. Thank you for plugging Fisker. Thank you for the electric vehicle opportunity. And I'm exactly excited about that, as you are. But you still make the point that SPACs are still relevant. They're another way to go public, and they give management team a better opportunity to kind of tell their story. And so I thought your comments about private equity were equally profound. It's going to continue to exist, but it's going to be much smaller, due to the limited opportunity. And, that you can't flip and monetize as easily as private equity once thought. And let's face it, like the industry as a whole, private equity returns have underperformed. And you made that point. I do think private equity, as you said, will diversify away from fossil fuel for the time being, and we're going to see them still involved, but they'll be involved in many, like the majors you commented, will be going to greener pastures, if you will, and I think that's going to take place. The large integrated companies are going to make that transition because they have to. Your point was about its sustainability, and for them, in order to attract the next generation of both employees and investors, they're going to have to make that move, and so they will. I love the comment, the dialogue, you brought it up several times about how the fossil fuel business is a global business and how it teaches you geopolitics. And you and I have known each other for, we won't say how many years, since it's longer than Ashley has been born. But the reality is we've seen this global world, and we've learned so much by being in it, and we're benefactors of that. And, the point you made about renewables, we're not there from a profitability standpoint, largely because the technology and the scale hasn't taken place yet, but it will. And so we can be encouraged by that. And then finally, in the last segment where you talked about careers, I love what you talked about. It's a great learning ground, and the energy industry has taught so much, and that it continues to be a great learning ground. And I don't think you can go in any industry better, because I think there's just too many facets of steep learning curves that you can embrace and do. And I will plug the last point you made, find a mentor. You make an excellent mentor. There are many of us our age and older that are excited about helping others and are willing. And I know, Ashley, you may be joking about blowing up Steve's phone, but I guarantee you he'll answer it. And so I want to encourage you to, I want you to encourage you to do that. So that's my wrap up. I want to thank you both. You did such a fantastic job.
It's been my pleasure. Ashley, thank you. I appreciate the dialogue.
All right.